In terms of the debate of moving into high growth markets in emerging markets and those types of markets, where do you see that growth and trend happening, and which are the target markets, and in what particular product areas do you see as the key?
Well, certainly everyone's interested in growth, and the developed world has a huge challenge on that front. And for a moment, I'll focus on the U.S. experience. You know, you look at a market that for the past 15 years has been driven by massive market structure changes. So whether it was the electronification of the NASDAQ market, whether it was decimalization, followed by Reg NMS in 2005, 2006, all these things drove volumes tremendously in the U.S. So you kind of had the home market growth. You didn't have to worry about it. Now, 2010 U.S. equity volumes down 13%, 2011 down close to 8%, and this year we're down again. So the markets in the U.S., and it's not just the U.S., it's Canada, it's Europe, that have also faced that U.S.-style market structure fragmentation that are challenged for growth. I think the problem is, and I'll get into this a little bit, I actually have the next presentation, so I won't steal too much of my own thunder for later, but when you look at the emerging market exchanges in particular, they have the growth. They don't need to do the deals. They do have an interest in doing some things. I think distribution arrangements are one of them, but in some instances they need technology. So there are deals to be done, but as we'll get into later, the mega deals didn't happen, and despite the speculation, every time there was an exchange asset around, you didn't see BM&F Bovespa or Hong Kong bid on them. And there's a reason for that, because they have the growth. Clearly the areas of interest are the emerging markets, commodities, derivatives, post-trade assets, but whether those are available or not is another story.
And are the deals more revenue sharing, sort of bilateral liquidity provision, or are they M&A deals?
Well, I think we're going to see a mixture still. You've seen, even in the wake of a lot of failed mega mergers, we saw ICE buy a stake in Cetip down in Brazil. But I think it's probably more likely to look like the Globex type deals that we've seen a lot of with CME and various emerging markets, or you're now even seeing the BRICS countries themselves work together on index product, which is interesting when you think about it from the perspective of there was a perceived necessity to work with the West, and not that they're not working with the developed markets on these distribution initiatives. They still are, but at the same time, they're saying, hey, as our markets mature and our pools of capital grow, there may be distribution benefits between us, as well as working together to create product that then can be distributed globally if we work together. So it's a real, to me, that was announced first at World Federation of Exchanges in South Africa in October. To me, that's a real sea change. We see it in the statistics when folks put up on the screen Asian derivative statistics. There's been a sea change, so we see it there. But this was, to me, a recognition by some of the emerging market players themselves that they're the attractive assets now. They're not, hat in hand out to the developed world. It's vice versa. The growth is needed by the developed world as public companies, something you got into earlier. So, and that's where it's going to be found. It's going to be found in the product classes that are going to grow, and then the geographies, and that's not going to be Canada, Australia, Europe, and the US. So,
and how are these structures working? Are they cross-listings, or are they passporting of memberships? What is the model that is being put in place to get the liquidity between the target emerging market and the predator, effectively?
Well, I think there's different ones, and it's still being figured out. I don't think, if you look at the percentage, let's say, of CME volumes that are coming from international or coming from overnight as opposed to the hours that CME is open, it's growing pretty steadily. But it requires a different model in different cases. It does require, you see even apart from M&A and alliances, you see the other day SGX announced a few weeks ago that they got one of their contracts approved by the CFTC. So there's also what I call self-help, where other market centers are coming to the U.S. and saying, okay, I need distribution, but I need to make it easier for people to trade my product. So there's that type of stuff too. But you see, everyone is pursuing different models. LSE is really trying to pursue, whether it's Mongolia or other markets, they're trying to list. You even see emerging markets like Brazil or Mexico trying to list other securities, whether it's in their region, Latin America, or global securities. Mm-hmm. Because again, those pools of capital are growing within their region. And in the case of Brazil, I think it's not fungible product, it's more of an ADR type setup, mm-hmm. But that's interesting to see an emerging market sort of attack mm-hmm. trading other product when it always was vice versa.
And if the emerging markets are doing so well, as shown in Patrick's presentation, what is the added value they're going to get from allowing international access?
I think it's still, there's still a reality that even as the growth rates are so much higher than the developed world, still the U.S. is the biggest capital market. Mm-hmm. Europe, if you look at the statistics, 20, 30, 40 years out, is going to decline, when we look at demographic trends and things like that. But there is a reality that is where the pools of capital, the largest pools, are still there. And it's also a matter, again, as these economies mature as well as their capital markets mature, they still are not the same as the U.S. markets or the European markets today. So I think that distribution is still very valuable. And you could look at it in terms of, Christian talked about passive assets and the growth of ETFs. I mean, look at the difference in the US ETF market versus even Europe, never mind Asia and other places. It's just more developed, so there is opportunity for these emerging markets to gain real volumes and gain real AUM in their markets from working with the West.
Okay, if Fraser Cowie can come up, who's from NYSE Liffe, but while he's coming up, if I can ask you one other question. So drilling into this, the value proposition from the mature markets to the emerging markets, what do they bring? Do they bring in, sort of, for example, HFT know-how, new styles of trading, new methods of clearing? Why is it attractive for the emerging market? Because there's a number of emerging market exchanges.
Sure. I think, first is that just outright distribution to the asset managers, to some of the high-frequency players. When you look at the high-frequency players, in certain markets, even markets that have targeted high frequency like Brazil, it can be quite challenging to them to get the setup in the data center and have, as a new matching engine is rolled out, as people tell me, oh, well, it costs 3 times as much for a server down there. So they may experiment with something like a Globex to access the market, and then eventually they may graduate to something else. So I think part is just the connectivity and the access to customers. And I think, you hit on a second point, which is, yes, there is some know-how and experience that comes with it. I personally think that in the case of, let's say, Brazil, despite Direct Edge and BATS announcing intentions to be there, I think that's going to be a difficult road for them to pursue, at least in the next 12 to 24 months. But eventually there will be competition in places like Brazil. And when that happens, I think it is valuable to have a partner that's gone through some of these things, because we're not U.S. centric in our outlook. We cover all asset classes. We cover the globe in terms of exchanges. But certainly the experiences that the U.S. had that then were to some extent exported to Europe, to Canada, to Australia, are valuable. And so even if whether you're in a developed market like Japan or you're in an emerging market, those experiences are worth looking at, examining yourself, but also working with folks who've gone through it.
Okay. Fraser, welcome. Tell us a little about NYSE, Euronexts, Liffe, and general approach to developing the emerging markets, please.
Okay, thank you, everyone. Well, NYSE Euronext is in itself an amalgamation of many, many different markets, and picking up some themes from earlier, our position today has been one really arrived at through consolidation and M&A. So in the developed markets, We've bought assets, whether they be technology companies, whether they be other exchanges, and have created a market whose products and customers are largely in Western Europe and in the US. As you look forward, I mean, the analysis I thought that Patrick did was very interesting. We too arrived at the same conclusion that the growth going forward wasn't necessarily where we had our core assets. It's in the emerging markets. And talking to customers, they want access to these products, and they want access for a number of reasons. One of which is these are high growth markets, but also they're less mature, and therefore that tends to mean the spreads aren't so tight. So there are bigger opportunities for, say, a Chicago-based HFT firm to enter a market and bring a different kind of return than they can in a more mature market. So we took a look at that a couple of years ago, and we've integrated a partnership program where we work with exchanges, cash and derivatives, often combined, in emerging markets, where we take the model that you described, where we link together. It's to do with distribution. We link our markets together so that our customers can get access to these emerging market products without having to build to every single away exchange. They just build to our interface. We do the work in the middle to convert it to look like the away exchange, and they get free access into these away exchanges, but going through the local infrastructure. So they will go through local brokers, and the broker then passes the exchange, the order on to the exchange. It's been a great success, a lot of interest from exchanges, and I would say that the focus isn't just Asia. I would say that basically Eastern Europe, Eurasia, Asia is where the interest lies, because some of the more interesting products like the RTS index are certainly not an Asian phenomena, but they're something that our customers want to get at, but they don't necessarily want to build to the away exchange. So they've come to us, and we're providing that access. And it kind of fits in a phrase our chief exec uses, which is more products for our customers and more customers for our products. So the more products for our customers are, can we provide through their access to us emerging market products? Can we leverage where we don't have distribution? Can we work with exchanges in other markets where they have customers and they have distribution who may wish to trade our products? And that's how it works, and to date it's been very successful.
So picking up on the latter part of that, what do? Do you passport their membership into the NYSE community, or how does it work?
No. What we do is we provide the translation technology so that we route from one of our members who has access via our network. It's called Safety. So anybody that's connected to Safety can route an order through to a broker in the chosen country. And so they then become a client. They may be a member of us, but they become a client of the partner exchange, and the order gets routed through one of their members, and the order goes into the exchange in the name of their member. So it respects the local infrastructure, and it means it's an opportunity for local brokers. They can capture net new international flow.
And is the barrier to entry on that the fact that the two members have to become clients of each other?
It doesn't have to be of each other, but yes, yeah. there needs to be a broker-client relationship formed. But that's how it works today anyway. People, if they wish to trade in a new market, they need to have a broker-clearer arrangement. We provide the enabling technology for them to get to them.
So there's no wholesale passporting of the membership of the
No. No.
Okay.
So in answer to one of the questions in the in the brochure, that kind of gets around some of the regulatory hurdles. One of your questions was, how do you get around some of the regulatory hurdles in the emerging markets? Our answer is, we respect it. So we drive flow through to existing brokers and then work within the confines of the existing regulatory infrastructure.
And then how does the post-trade function work? So you've managed to communicate with each other. You've got a trade.
Yeah.
How do you clear it?
Exactly as today. So if you're trading into Japan, you trade through the Japanese clearinghouse and the Japanese infrastructure. And you are a client of a member who is a clearing member of that infrastructure, and you will get your confirms and fills and reports back in exactly the same way as you would today.
Okay, so picking up on some of the points that were in the previous panel, does that sort of break down some of the barriers on competition, the model that you've created? Effectively, you've overcome a mechanism because it's basically client to client. You're not there as the exchange, effectively.
I don't think it necessarily breaks down barriers in terms of competition, because we tend to work with one market in one jurisdiction. Although we have examples. I mean, for example, we've set up something people may have seen at our liquidity hub in Tokyo, where we provide access to OSE, TSE, TFX and other markets, and people can actually co-locate with us in our liquidity center and then get access to all those markets through that center. So you could say that that's helping to break down competition, but the model I described tends to be a partnership one, a revenue share one, where we work with a designated partner. And there could be more than two in one country. In most countries you have an integrated cash and derivatives exchange, in some you have a separate cash and derivatives exchange, and we're open to working with both models.
Okay. One of the exchanges that you've taken a stake in is the Qatar Exchange, Frontier Exchange, emerging market. How have they benefited from your involvement, and do you believe it's been a success?
Well, first of all, disclosure, I am a board director of the Qatar Exchange, so I must wear that hat as well as being a representative of NYSE Euronext. It's been a great partnership. We took a 20% stake alongside the Qatar Holdings, which is in effect the Qatar Investment Authority, and collectively we bought the Doha securities markets 3 or 4 years ago. What we've brought to the table is our technology and our expertise, both in terms of legal and regulatory, and all the issues Craig was talking about. Is it Craig Hewitt? Yeah, the issues that Craig was talking about in Dubai. I was inwardly smiling because we're going through the same issues in Qatar about short selling, and so we've brought a lot of expertise and helped to develop that market, and we have the cash market live now. In terms of the exchange, they've benefited from our experience, and I think maybe the regulator has too. And from the QIA's point of view, they've got a partner who is an expert in this particular field, and it's helped them develop their investment. So it's worked for all parties, and the customers have got far more liquidity, and there'll be more to come as we develop that market further. So I think all stakeholders have seen a positive outcome from that particular arrangement. Okay,
Mustafa Baltaci is Executive Vice Chairman of the Istanbul Exchange, comes up. But while he's doing that, Fraser, one last point. And on the Qatar Exchange, is that planned to develop into the derivatives space, and if so, when?
There is certainly a desire to develop a derivatives market there. There is no date disclosed as yet, but you can expect to see the Qatar Exchange develop more into that area. It's certainly not this year. And again, some of the points that Craig raised about derivatives and the challenges of local law are just as evident in Qatar as they are in Dubai. So we're working with the regulators, and we hope to introduce derivatives, but it may take some time.
Excellent. So Mustafa, welcome. And to the IMKB, the new name. You are one of these target growth markets. So how are you holding yourself out to the international place to develop with other partners coming from abroad, or are you just trying to develop your own market and maybe look to the FEAS region and develop that on your own? What is your strategy?
I don't know if it is an official definition as defined as a high growth market. I think it is advanced emerging market status by FTSE. Anyway, but if you look at the rate of return, we might be one of the high growth markets. Yes, it is true that we had a huge blow during the financial crisis in 2008 and 2009, but we bounced back. The recovery is quite enormous, and we are doing pretty well in terms of the index performance, particularly this year and the second half of the last year. What we offer to the international investors and the players is, I think it's more of a liquidity. Mm-hmm. And when you look at the numbers in the equity market, almost 65% of the free float is carried out by the foreign investors. So meaning that there's an interest from the international arena. Well, we have also a very liquid fixed income market. Daily trading volume is quite high, alongside with a repo market. I think it's one of the unique and peculiar markets around the world. And the daily trading volume is quite high. It's around, it's about $10 billion a day, including all of these markets. We are trying to embark on some of the derivatives instruments. We launched a warrants market last year, and it is picking up. For the time being, I think there are 150 warrants trading on the market. And we have ETFs. They are doing okay. So we are trying to diversify our products pool, as well as trying to promote ourselves as a market, which would be very interesting to some of the foreign as well as local investors.
And the volume that comes from abroad, is that by each investor, or have you found some way of wholesaling in a whole community from another market?
It's more of a wholesale from the institutional investors. When you look at the volume, daily trading volume, it's more of a retail investors trading daily, almost 80%. But the holding period for the retail investors is something like the East Asian markets is quite short. But the institutional investors from the foreign countries, they are holding the shares for a long period of time. So there's a balance and a combination of both.
And tell us a bit about what you're doing in the FES region. I think you're providing some technology and education and other services out to the other markets to try and grow a community in this space.
I think in terms of the level of progress and the development, İstanbul Borsası is one of the leading exchanges in this region. And leveraging on this, we have this Federation of Eurasian Stock Exchanges. We are playing a key role there. I am the Secretary General of it. But this is a broad geography, and we have almost 30 countries within the federation. It's, I think, the second largest federation after the WFE. And we have some Balkan countries, some Central Asian countries, countries in the Middle East. And well, we have some projects, like joint indices. We have 4 indices so far. And the last index was the tradable index. We launched it last November. And it is something quite good for promoting the regional markets as well as the exchanges to the foreign investors. Aside from this, we have some projects like market linkages. We have a well-known strategy which is called Common Technology Platform or Joint Technology Platform. We are trying to do it within the Istanbul Financial Center project, but it has a lot to do with the FES region. And if you can do it, there's going to be a single access point for the Turkish local markets, integrating all the niche markets as well as the single stocks and derivatives markets within this platform. The next step will be integrating the FES markets, Azerbaijani, Kyrgyz markets, as well as Mongolian, Kazakh markets, as well as some Middle Eastern and Balkan countries. And we are also trying to talk with the some of the Western exchanges, and they seem to be interested in this, platform. So if you can do it, it's going to be something huge, and it's going to be helping us to create more liquidity in the local markets.
So from an international perspective, does that mean that the foreign either exchanges or investors could look at the whole of the FAS region as one, and basically come into a single legal regulatory technology environment and reach out to the whole community, or are they still going to be 30 fragmented markets? Well,
it is the purpose actually to make sure that investors will be accessing only one single point in terms of the clearing, regulatory schemes and everything, but it's not something very easy. Sure. It takes a lot of effort and everything. We have to make sure that the clearing agencies should be speaking to each other to make sure that there is one harmonized framework for them. If we can do it again, it is going to be one single access point, and we'll be able to, link all these markets with each other. So it's like, aggregated model of a typical order routing platform.
Okay. Picking up your point about clearing, Fraser, what is the NYSE clearing strategy that will benefit this international emerging market development?
Well, as you know, our plan as part of last year's potential merger was to move clearing into Deutsche Börse. And we, obviously that plan is no longer open to us. So we're in the process of building out our European clearing platform now. We already have the clearing technology, although LCH Clearnet have been clearing for us for 30 years, they've actually been using our technology to do so. So we're busy updating that. We have something called NYSE Liffe Clear today, and probably about 2/3 of the processes are already in-housed within NYSE Liffe. There are still certain functions like the default fund that are held within LCH, so we will bring those in-house before the end of next year. On the US side, you may have seen an announcement last week that we have a market out there, NYSE Liffe US, that trades short-term interest rate and treasury futures. We have a clearinghouse called NYPC, which is a joint venture with the DTCC. And the DTCC clear all the cash and repo markets in the US. So what we do is we offer portfolio margining between cash and futures, and that's for house positions, and that's already got us to 10% market share in US interest rate products, which is quite an achievement in 1 year. There are a number of developments that we will be bringing out this year. Portfolio margining will be extended to client positions, and we've announced that we will be launching options as well, so they'll be included in the same pot. And last week we announced a deal with LCH Clearnet, so whilst our relationship is changing and maybe shrinking in Europe, it's expanding in the US. We'll be offering margin offsets not only between futures, options, cash and repo, but also interest rate swaps, and they are the dominant platform for interest rate swaps. So it's a very interesting proposition, and as you go to Asia, I don't think until you spend much time there, you realize how important the dollar economy is. And we talked about the opportunities coming to Europe as Asia develops. I think there's more opportunities going to the US as Asia develops. But they are very major users in the Asian time zone of US interest rate products and US treasuries. And I think the capital efficiencies that we will bring with this venture with our new clearing partner in the States will drive efficiencies for Asia and any other customers that happen to use those products.
So your European and US strategy will be portable into the emerging markets to some extent, or usable?
Our strategy is within the US and European markets is to continue to develop and enhance our offer. As I said, we got here through M&A and consolidation. That's not our approach for the Asian markets. We don't intend to open exchanges in the emerging markets. We don't intend to try and be a player in the consolidation of those markets. We want to work with the local exchanges. So our clearing model will remain a European and US one. It's not something we're going to transport and drop into Singapore or Hong Kong. So
maybe some interoperability or something like that.
Yes.
Possibly. Are there any questions from the audience? There's one over there. Can give your name and organization, please. It's further down on your left.
Sorry. Thank you. Adam Eads from BATS-CHIEX Europe. I have a question for Fraser. Just really to understand, Fraser, how does NYSE Euronext generate revenues for itself through this partnership model that you described?
Okay, again, back to full disclosure. As the ex-legal counsel of Liffe, of course, you know the answer to that question, but I will answer it on your behalf. It's a revenue share model. So when we send volume to away exchanges, then a percentage of the exchange fee will come to us, and when an order is shipped from the away exchanges customers to us, a percentage of our exchange fees goes to that away exchange, and that percentage may vary, but it's always equal and opposite. So if it's X one way, it's X the other way. So that's how it works, and it's not changed since you left, Adam.
You're just checking whether things have changed. Any other questions? There must be some more. One final question. What are the sort of bilateral projects that Istanbul is doing with other exchanges?
Well, we have created some partnerships with some of the exchanges in the region. For example, we are shareholders in Kyrgyz Stock Exchange, Baku Stock Exchange. We just became a shareholder at Sarajevo Stock Exchange. The reason behind this is to make sure that there is a level of exchange of information, know-how, and expertise between these exchanges, because we have this motto or the philosophy to make sure that local exchanges should be built on their own strengths and local strengths. And besides this, we are talking to some of the markets in the region, as we did with the Athens Stock Exchange. We are trying to embark on some of the joint indices projects. There's this project going on with the Abu Dhabi and Dubai exchanges. Egyptian exchange is another one. Perhaps with Qatari, we had a talk with them as well. I'm not sure if you're aware of this.
Come to the board.
All right, okay. KRX, there's a concrete project with them as well. So those are sort of the concrete projects we are taking care of for the time being.
And all of these sort of, do you see them as generating additional revenue?
Hopefully they will.
Okay. So it's infrastructure for the moment, and then
That's right.
down the road it might
That's
be
right.
revenue.
That's right.
Okay, if there are no more questions, then... Oh, there's one more, and then...
And to Mr. Cowie, please. If you're connecting from a single data center to trade these emerging markets, is there any, or what are the chances, or is there any way, or is there any case in which you can beat a local competitor who will be actually co-located at the emerging market?
I think NYSE Euronexts are capable of many things, but as yet beating the laws of physics probably isn't one of them. So if somebody is co-located right next to a matching engine, then of course there's always latency in getting from A to B, and if A to B is a longer distance, then there will be some latency. I think the main appeal and the kind of users that are looking at taking the service are not necessarily the top-end HFT firms, because their models just don't work in that environment. But there are plenty of people who use the market, broker-dealers, maybe point-and-click traders, where the relatively small latency, which is fractions of seconds, is more than outweighed by the fact that, in effect, it's free, and they don't need to spend several $100,000 in building to a new market. So, yes, there will be some latency, and yes, the local player will always beat them, which is always intrigued me a little bit about the Bursa Malaysia deal with CME, where their matching engines are now in Chicago. How is the local retail guy in Kuala Lumpur going to get a better fill than a Chicago HFT firm who's co-located several thousand miles away? But the latency is with us, and we do our best to minimize it, but we can't beat it.
I was just going to add, I mentioned it earlier, that certainly some HFTs will experiment with some of these arrangements before they make a commitment to go full on into a market, to start to understand the market and the liquidity. And HFT is not, is a bunch of different strategies. So I would say stat arbs, as a for instance, as opposed to the automated market makers, which those tend to come to the market later, the automated market makers. The stat arbs who are doing, let's say, an ADR arbitrage, the type of latencies you might get through using a US access point are actually quite fine in most instances. So we find when we talk to HFTs, some of them actually do use these things, especially out of the gate.
Okay.
Yeah, good.
Thank you. Well, with that, I'd like to thank the panel, and we'll move on to the next session. Thank you very much.